Good morning, ladies and gentlemen. Frick is short for Frederick, if you were wondering, and you can find me on Twitter at FrickEls and on LinkedIn at FrickEls. And since I'm the only thing between you and lunch, I think we should frickin' start. Will electric vehicles spark another mining supercycle? Perhaps first we should ask, is the China-induced supercycle really over? Mining.com was launched in February 2011. On the 16th of that month, iron ore reached a peak of $191.90. When I checked this morning, iron ore was in the late 60s, with little prospect of ever seeing triple digits again. Mining industry doomsayers are quick to point out that China's rate of economic growth is now back to that of the late 1980s. But I find it somewhat baffling that investors in depleting assets and finite resources do not focus on absolute numbers. This is what will be added in nominal dollar terms to the Chinese economy this year. The equivalent of half a Texas, one Turkey, two South Africas, three Philippine archipelagos. Do you find this reassuring? Well, you shouldn't. And I'll explain with the help of Chinese opera. I'm not a fan of the art form, and apparently not many Chinese are either. In 2011, there were more mining firms in China than cultural associations, entertainment companies, and sports bodies combined. 4 short years later, the ratio already looks very different. Beijing is succeeding in moving China away from an investment-led economy reliant on infrastructure build-out to one driven by consumers and the services sector. She may be applying copious amounts of bismuth, but phase 2 of the Chinese boom is not going to be nearly as resource intensive. I have to confess, researching for this presentation, it made me nostalgic for the early days of Mining.com. It was a simpler time, ladies and gentlemen. I had to know what goes into a steel mill. Now, I have to know what goes into this. It's the motor used in Europe's best-selling electric vehicle, the Renault Zoe. To me, salient pole synchronous reluctance sounds more like a bad date than the future of mining. More than 500,000 user sessions per month. I would think that Mining.com acts as something of an indicator of trends within the industry. Since launch, gold and iron ore was consistently our most read and commented on articles. That's no longer the case. This McKinsey study is one of our most popular posts of 2018. I compiled a great many charts for this presentation, but it was soon clear that they all look pretty much the same. They start in the bottom left corner and they end in the top right. So instead of repeating what you probably already know, or might be quietly praying for anyway, I'm going to focus on the broader impact of electric vehicles on mining. There is one graph I need to show, though. I'll let these numbers sink in a little bit. What makes this graph even more astonishing to me is that these percentages refer to incremental demand from electric vehicles only. To me, aluminum was a surprising figure here. 1/10 of reserves depleted per year, according to this UBS study. 3 years, and all the cobalt is gone. This forecast is, of course, based on all sorts of assumptions. But if you'll allow me an atrocious metaphor, I do believe cobalt is indeed the canary in the electric vehicle coal mine. This is Mining.com's most popular post of 2018. And that's not just because bad news sells. Researchers discovered a way to eliminate the need for cobalt in batteries entirely, replacing it with iron and making it last 4 times longer in the process. Of course, this is just a laboratory study, but it's an indication that thrifting and substitution of today's battery materials is the #1 concern for investors in the sector. Some of the nervousness about cobalt is unwarranted. In August this year, South Korea's 2 largest electric vehicle battery makers delayed implementation of chemistries for nickel manganese cobalt, which would cut cobalt loads by half. Elon Musk has done his part to scare cobalt investors, claiming that the Tesla Model 3 already has less than 4% cobalt in those batteries. But as we all know, Mr. Musk makes a great number of claims, many of which have gone up in smoke. Apart from making batteries last longer, cobalt's #1 benefit is safety. And if there's one factor that would slow adoption of electric vehicles, it would be fire concerns. 9 of the 10 largest cobalt mines will be in the not-so-democratic Republic of the Congo by 2022. China has no cobalt resources of its own, but it produces 80% of the world's battery-grade cobalt compounds. This makes Western vehicle manufacturers and tech companies very nervous. I was highly skeptical about the idea that automakers, never mind Apple, will make direct investments in mining projects. Then reports like these, and this is only a small sample, began to surface. Automakers and cell phone manufacturers will likely have to pay a premium for conflict-free cobalt and are setting up alternative supply chains. China is and will be the #1 EV market, but unlike the previous supercycle, it won't be all about China. The Nokia 8110, still the greatest cell phone ever made, but that's a conversation for lunch maybe. It's worth remembering that last year, only 10% of cobalt production went into EV batteries. Mobile phone batteries contain 40% cobalt and will remain the #1 source of demand for the next 5 years. And that's even with rapid EV adoption rates. I chose cobalt to illustrate EV demand patterns, but the same dynamics are at work with other metals, notably copper, where demand from internal combustion engines will remain above electric motors for at least the next 7 years. Government regulations played a huge part in kickstarting the move to EVs. It can also disrupt. This was our top story in July about changes to Chinese EV subsidies. Examples like Ontario's scrapping of incentives won't help, but government rules will continue to be a net benefit to the electric vehicle market. Just last month, California reported, and California has a car market equal to the size of that of France, wants to double its green energy vehicle incentives. Amid the many headlines about EVs, this one really jumped out at me. Not what it says about electric vehicles, but what it says about the future of oil. Will electric vehicles drive the next supercycle? Well, apparently private capital doesn't think so. Private capital, including pensions, sovereign wealth funds, endowments, and the like, have been pouring money into resources, just not into mining. In 2017, private equity funds raised more than $61 billion for oil and gas plays, with the bulk going into North America, North Dakota and Texas. Mining-focused funds raised 24 million. That's million with an M. So I guess somebody had a rich aunt or something. 2018 already looks very different. Orion closed the second largest mining-focused fund ever during the first quarter. Mining dry powder, funds that are ready to be invested, should reach $15 billion by the end of this year. Automakers are in highly unfamiliar territory. Purchasing departments in Dearborn, Ingolstadt, Aichi Prefecture must now navigate places like Madagascar, Papua New Guinea, and the Congo, and figure out tricky markets like rare earth, lithium, and cobalt. Even after the run-up in price, cobalt is still just a $5 billion market. Toyota does $5 billion in a week. At a conference in London last year, Robert Friedland called it the revenge of the miners. Bargaining power is now firmly back in the hands of miners. We've turned the tables on Mercedes, Ford, Toyota, and all the others, but they only have themselves to blame. Look at this KPMG global survey of auto execs. Only last year was battery electric vehicles indicated as the top trend within the industry. 3 years ago, it was at number 9. EVs were also considered less of a thing than the pink-colored trend in this graph, which is innovative urban vehicle design. I'm sure innovative urban vehicle design was also a trend in 1955. That's when the Messerschmitt KR200 Kabinenroller was first produced. Car companies are not just late in locking in supply of raw materials. They also face deep-pocketed competition. And that's from a sector that's not afraid to throw around money. At $100 billion, the SoftBank Vision Fund, with backers that include Apple and Daimler, it's the largest tech fund ever assembled. In January of this year, the Vision Fund invested $300 million, for a minority stake, I might add, in the makers of this dog walking app. In April, that same fund did this. Tech and automakers descending on mining is transforming the industry. But the ramifications go well beyond investment in the sector. Full disclosure, before mining.com, I was an automotive journalist. I was only 5 when this came out, but I admit this is still my dream car. Aston Martin launched the famous wedge-shaped Lagonda in 1976. It was during the aftermath of the OPEC oil crisis, and not long after the founding of Greenpeace in mining.com's home base, Vancouver. At this year's Geneva Auto Show, Aston Martin heralded the return of the Lagonda brand as an all-electric vehicle. It positions the company as a symbol of the green energy revolution, and it makes an elegant point about our electric car future. Production is set to start in 2021. That is, if Aston Martin can secure enough cobalt, lithium, nickel, copper, manganese, graphite, aluminum, and rare earths. Thank you.